Let's face it, we all want passive income, and a lot of people look to covered call ETFs to provide just that. But a lot of critics are quick to point out that covered call ETFs sell part of their upside and usually lag the underlying index. But today I want to explain how Canadian covered call ETFs have been combating this all the way since 2023 by applying very slight leverage. They've not only been able to keep up with their underlying, but many of them outperform. And here in America, a new fund, TDAX from Tap Alpha, is using the same strategy, and it's had phenomenal results since its inception date earlier this year. So TDAX is actually the leveraged version of their other fund, TDAC. The fund seeks daily investment returns before fees and expenses of 130% of the daily performance of TDAC, their NASDAQ 100 fund. The fund does not seek to achieve its stated investment objective for a period of time different than a trading day. So how does this differ from other common covered call ETFs like QQI or GPIC? It's because the underlying asset, TDAC, actually uses 0 day to expiry covered calls. That means that the expiration date is the same day they write the call. While other covered call funds may only write on the notional once a month, this fund is doing it every single day. And honestly, it's proven to be a profitable strategy as TDAC has consistently performed at the top of the list when it comes to NASDAQ covered call ETFs. TDAX is just that same thing with 1.3 times leverage. That seems like an odd number, doesn't it? 1.3? I can't prove it, but I do believe they chose this value based on several Canadian covered call funds that have not only kept up with their underlying, but outperformed over vast periods of time. And most of those use about 1.25% leverage. The fund I've been investigating the most lately is QQCL, a Canadian fund listed on the Toronto Stock Exchange that's leveraged by about 1.25%. And if we jump over to stock analysis, we can see that when we compare the Qs with QQCL, the Canadian fund, and TDAX, the new American fund from Tap Alpha, we see very similar performance since the inception of the most recent fund, TDAX, earlier this year on January 7th. The Qs have returned 17.54%, QQCL at 17.64%. It's actually outperforming the underlying over this time period. And then TDAX is very close by at 17.2%. But if we scroll to just earlier this year on May 29th, we can see that TDAX actually had a large lead, returning 20.74%. to the Q's 18.58%, while QQCL lagged over that time period. Looking at this chart, we can extrapolate that the purple line, TDAX, did fall significantly more during the March 30th correction. And this is probably due to its increased leverage at 1.3 versus 1.25, and the fact that they're doing 0 DTE calls. But we see that on that recovery, it actually recovered very, very well up to that peak. If we remove TDAX from the chart and go all the way back to October of 2023, when QQCL, which is QQCL's inception date, we can see that over that time period, QQCL's actually outperformed the Qs at 103% versus QQQ's 101.51%. So I'm starting to think that the magic of outperforming might come down to just very slight leverage in these covered call funds. And before this next part, I just want to ask that if you're not already subscribed, please hit that subscribe button. 99% of my viewers are not subscribed, so that would really help the channel out a lot. And that's just looking at total return, but on a price return basis, we can see that since inception, TDAC has returned about 3.5%. while other fan favorites QQQI only returned 2.52% on a price return basis. As always, GPIC, one of my other favorites, returned about 8.55%. With GPIC in particular, you do get a lot more price appreciation than the other funds. TDAX does have an absolute monster distribution rate currently at 19.36%. So the bulk of the return of this fund is coming back to you in the form of distributions. Going over to Seeking Alpha and looking at the consistency of those distributions, we see that all of them have ranged from about 8 cents to about 12 cents. And one thing I want to point out that makes this fund unique as well is that they're actually paying out weekly versus a lot of the other covered call funds, which are monthly. And we can see that for the month, usually once it picks its distribution, it sticks to it for that month. So the most recent 4 weeks, we can see they were all 9 cents. And then before that, they were pretty congruent at 12 cents. And then 11, we do have a low in May of around 8 cents. And then 10 cents before that. So there is some very slight variance in the distributions of this fund. So unlike a QQQI, which seems to just pay out the exact same amount within a couple of pennies, there's a bit of a higher variance in this fund's distributions. So I would take that into consideration if you're taking the distributions out and living off them immediately. These distributions may be a little more volatile than something like a QQQI. We have the expense ratio at 0.98, which I think is fairly reasonable considering they're writing these covered calls every single day, unlike other funds which may only be writing them once in a month and then rolling them a couple of times. So you are paying a little more for the active daily management, but I think that is paying off in the total return as it is keeping up with the Qs very, very well. The main benefits of holding funds like this is always a percentage of return of capital. I think that's one of the Achilles heels of some of the older funds like JEPI and JEPQ, which pay out predominantly ordinary income. We like to kick the tax can down the road as long as we can, or even tax gain harvest and pay sometimes even 0% tax on these funds if they're mostly return of capital. And we can look at the 19A1 notices, which by no means are an exact certainty. The number will vary at the end of the year, though the estimated return of capital every month seems to be between around 91 and 94%. So if at the year end 1099 it is 90+%, that will be an absolute strong plus for this fund. Zooming out since inception and just comparing it to some more standard non-leveraged and leveraged American covered call ETFs, we can see that TDAX has returned 17.12% since inception, whereas the Qs are right at 17.45%. TDAC, its underlying, is coming in with a strong 15.81%, and it's actually, without leverage, outperforming the NEOS leverage fund XQQI. From an assets under management standpoint, JEPQ is an absolute behemoth, but it's only managed to return 10.2% over this time period. And then QDTE, I wanted to point out, because this is an older fund from Roundhill, which also follows a zero DTE strategy. And we can see that it has performed even better than JEPQ at 14.44%, but not as well as some of the newer funds or the leveraged funds. And while this fund is very new with an inception of January 7th of this year, we don't have a ton of data to extrapolate it on, though this is the part of the video where I'd like to look at QQCL and go back to its inception. And while again, we don't have a ton of data on this fund to go by, we can look at a very similar leveraged fund like QQCL, which does go back to 2023. And again, pulling up that chart, it has slightly outperformed the indices. And we can see that on occasion, TDAX has actually outperformed as well. So I'm hopeful over the long term, TDAX will at least be able to keep up with the Qs, if not outperform by a slight margin. Keeping up with the underlying or outperformance may not be as important to you if you're an older investor and you just want that yield that's stable, which is why I think a lot of people are drawn to something like QQQI from NEOS, because the distributions are stone cold stable and the distribution rate at 14% is nothing to slough at. It's very significant. But if you're a younger investor looking to supplement some of your income and you don't want to give up any of that upside, I think TDAX might be something to look into. But as of the recording of this video, the assets under management are actually increasing by the day. And for TDAX, we have around 58 million. And then TDAC, the underlying, which is slightly older, we do have net assets in that fund at 313 million. So we definitely never want to get into a fund with too low of an assets under management that would be at risk for liquidation. So I'm very happy at the net asset value increase of these funds, and I'm very pleased that TDAC has now surpassed 300 million. So for me personally, if I were going to put all my eggs in one basket, this would be a very good contender for that basket. I really enjoy that it pays out weekly. I'm the type of investor that loves seeing my dividends and distributions come in, and they give me motivation to go out, work harder, make more money, and just watch that snowball get bigger. So I think that's one of the big benefits of this fund. I'd really like to see them in the future, though, tighten up those distributions, because there's a big difference in 12 cent one week and then going down to 8 cents. So I'm curious to see what you guys think. Leave me a comments down below. I try to respond to every single one of them. If you're in TDAX, if you'd ever heard of it, or if you're in TDAC and haven't pulled the trigger on this one, any pitfalls that you guys see, I'd love to hear them all in the comments below. And always hit that subscribe button, and I'll see you guys in the next one.